Meet Jack and Noah. They're both 28 years old. Both hold down stable, full-time jobs. Both earn around $85,000 a year. For years, they've lived below their means, skipping the overseas holidays, driving secondhand cars, and squirreling away every spare dollar they could. And after all that discipline, they've each managed to save up $50,000. For both of them, it's the biggest financial milestone of their lives so far. Jack has always believed property is the surest way to build wealth in this country. He likes owning something solid, bricks and mortar he can drive past and point to. Noah sees it differently. He reckons the best investment is the one that quietly does its thing in the background without eating up his weekends. So today, we're not just comparing where they put their money, we're comparing two completely different philosophies for building wealth. Let's follow their journey over the next 20 years, because the outcome is nothing like most people expect. Let's get into it. Jack decides to use his $50,000 as a deposit on an investment property. He finds a well-kept 3-bedroom house in a solid regional center listed at $250,000. After weeks of scrolling realestate.com.au and driving out on weekends for inspections, he settles on a place with genuine rental appeal. To fund the purchase, he takes out a 30-year mortgage at 7% interest. On top of that comes stamp duty, conveyancing, and building and pest inspections. Call it another $12,000 out of pocket before he even gets the keys. His monthly mortgage repayment comes in at around $1,330. A few weeks after settlement, he lines up a tenant willing to pay $450 a week, about $1,950 a month. On paper, the numbers look fantastic. Rent comes in, the mortgage goes out, and it looks like Jack's pocketing a tidy surplus every month. It almost feels too easy. Noah takes a completely different route. Instead of buying property, he tips his $50,000 straight into a low-cost ASX 200 index fund. No leverage, no tenants, no tradies to chase. After covering his living costs and topping up his emergency fund, he's got about $200 left over each month, so he sets up an automatic monthly investment and forgets about it. Noah's investment doesn't feel exciting. There's nothing to drive past, nothing to renovate, nothing to proudly show his mates at a barbecue. Just a number quietly ticking over inside an app on his phone. On day one, Jack looks like the obvious winner. He owns a house, he's got a tenant paying him rent, and he feels like a proper investor. Noah's just got a brokerage account and a confirmation email. One investment feels real, the other feels invisible. But building wealth was never about what feels impressive. It's about what actually works. In the early years, everything seems to be swinging Jack's way. The rent lands every fortnight. Every repayment chips away at the loan. He drives past the property after work and quietly thinks, "That's mine." Noah's experience is far less dramatic. Every few months, he logs in, sees the balance move up or down, and logs straight back out. There's no tenant thanking him, no property to show off, just numbers shifting quietly on a screen. Jack's mates constantly ask him about the rental. Noah's mates barely ask about his portfolio at all. From the outside, Jack looks like the sharp investor. Noah just looks patient. 3 years in, let's check the ledger properly. Over those 3 years, Jack's collected roughly $70,200 in rent. His mortgage repayments have totaled about $47,888. On paper, that's nearly $22,000 ahead. But that number only exists on paper, because the moment you own an investment property, the bills start rolling in. Council rates, landlord insurance, routine maintenance, a stretch with no tenant, advertising for a new one, none of these costs looks huge on its own, but together they quietly chew through what looked like easy profit. Then there's Jack's time. To save on fees, he self-manages the property, which means late-night calls about a busted hot water system, weekend inspections, chasing quotes from tradies, and organizing repairs on his lunch break. By the end of year 3, that $22,000 he thought he'd banked has shrunk down to just a few $1,000s once everything genuine is accounted for. And that's before you even put a dollar value on his own time. Noah, meanwhile, has had a far less dramatic 3 years. His original $50,000 has kept compounding, topped up by another $200 a month without fail. Assuming the market delivers something close to its long-run average of around 9 to 10% a year, his portfolio has grown to roughly $76,000. He hasn't fielded a single call about a leaking tap. His money has simply kept working in the background. But Jack still has one massive advantage: leverage. His property, bought for $250,000, is now worth somewhere between $275,000 and $280,000. Every repayment has also chipped away at the loan. His equity now sits around $80,000 to $85,000. That's genuine wealth, and a big chunk of it came from controlling a $250,000 asset using only $50,000 of his own money. That's the unique power of property, and it's something a share portfolio simply can't replicate.
Here's the part almost nobody talks about at the barbecue. Rent isn't profit. It's only where the story begins. First, there's vacancy. No rental stays tenanted forever. A sensible rule of thumb is to budget for around 2 to 4 weeks of vacancy every year, time with no rent coming in while the mortgage still needs paying. Then there's turnover. Cleaning, a fresh coat of paint, minor repairs, advertising, and screening new tenants. Every changeover quietly eats into your return. Ongoing maintenance is next. A rental property is a physical asset, and physical assets wear out. A leaking tap, a dead dishwasher, an air conditioner that packs it in during a heat wave. A common rule of thumb is to set aside roughly 1 to 1.5% of the property's value every year for maintenance. On a $250,000 property, that's $2,500 to $3,750 annually. Then come the big-ticket items: roofs, hot water systems, hills hoists that finally give up the ghost. These aren't unexpected, they're inevitable. The only question is when. And when they land, the bill can run into thousands of dollars in a single hit. Finally, there's property management. Hire an agent and expect to pay 7 to 10% of the rent, plus a letting fee each time you get a new tenant. Manage it yourself and you're simply trading money for time. Either way, someone pays. That's why seasoned property investors never calculate their return using rent minus mortgage alone. The real number only appears once every hidden cost is on the table. And that's exactly what happens to Jack. 5 years in, Jack's no longer the wide-eyed first-time landlord, he's a seasoned one. He's been through 3 different tenants, the hot water system needed replacing, a burst pipe appeared out of nowhere on a Sunday night, the place sat empty for 6 weeks between tenants at one point. The good news is rent has crept up to around $500 a week. The bad news is, so has everything else. Council rates, insurance premiums, and maintenance costs have all climbed. Once it's all added up, Jack's real cash-on-cash return settles somewhere around 3 to 5%. Still respectable, just nowhere near the 15 to 20% some property spruikers casually toss around online.
Noah's journey, by comparison, looks almost boring. Nothing dramatic has happened. He hasn't chased a hot stock tip or tried to time the next downturn. Every month, another $200 quietly goes into the index fund. That's it. By year 7, his portfolio has grown to roughly $120,000, and something important is starting to happen. His investment returns are now generating more growth each year than many of his contributions. This is where compounding quietly shifts gears. The early years barely feel rewarding. Then the gains start producing their own gains, and the curve gets steeper from here. Underneath the surface, both men are building wealth, just in very different ways. Jack's wealth depends on leverage, capital growth, rental income, and active management. Noah's depends almost entirely on time. One demands ongoing involvement, the other demands ongoing patience. By year 10, things get genuinely interesting. Jack's property is now worth somewhere between $335,000 and $370,000, depending on how the local markets performed. His remaining loan balance has fallen to roughly $172,000, which gives him somewhere between $165,000 and $200,000 in equity. Not bad at all, but that equity hasn't come free. Over the decade, he spent roughly $28,000
$20,000 to $32,000 on rates, insurance, maintenance, repairs, and vacancy. Noah's portfolio tells a different story. His original $50,000 plus a decade of steady $200 monthly contributions has grown to somewhere between $170,000 and $180,000. Over that time, he's personally put in around $74,000. Everything above that has come purely from market growth. No debt, no tenants, no repair bills.
At this point, something surprising happens. Their total wealth is remarkably close. Depending on how the property markets performed, Jack might even be slightly ahead, largely thanks to leverage. But the numbers alone don't tell the full story. Jack got here while carrying hundreds of thousands of dollars in debt, with his entire investment tied to a single property in a single suburb. He's put in hundreds of hours managing it. Noah, meanwhile, owns tiny slices of hundreds of companies spread right across the economy. His investment can be sold in seconds if he ever needs the cash, and outside of one automatic transfer each month, it's asked almost nothing of him. By year 10, neither man has clearly won. They've simply taken two very different roads toward almost the same destination. Another decade rolls by. Now we're looking at the full 20-year picture. Jack's property has kept appreciating, and depending on the local market, it's now worth somewhere around $500,000. His loan balance has fallen substantially, leaving him with approximately $385,000 in equity. Across those 2 decades, the property has generated roughly $115,000 to $120,000 in net cash flow after every expense is accounted for. Some investors in similar situations will do better, others will do considerably worse. Property outcomes depend heavily on the suburb you bought in, the tenants you attract, and how well the asset was managed. Noah's 20 years have looked very different. His original $50,000 has kept quietly compounding, topped up by another $200 every single month. Nothing exciting, just consistency. Assuming the market has delivered something close to its long-run average of around 9 to 10% a year, his portfolio has grown to approximately $518,000. Over those 20 years, Noah's personally contributed around $98,000. The remaining $420,000 plus has come purely from compound growth. No debt, no tenants, no repair bills.
So when you line up their final net worth after 20 years, the result surprises most people. Jack finishes with approximately $505,000 in total wealth. Noah finishes with approximately $518,000. Two completely different paths, almost the exact same destination. Yet the journeys couldn't have looked more different. Jack built his wealth through leverage, Noah built his through compounding. Jack accepted concentration risk tied up in one asset in one location. Noah accepted market volatility, watching his balance swing with the broader economy. Jack invested his time alongside his money. Noah invested patience. Neither approach is automatically better. They're simply different. At this point, it might sound like shares are the obvious winner, but that wouldn't be a fair conclusion either, because shares carry risks that are every bit as real. They're just easier to ignore. Market crashes can be brutal. In 2008, broad share indexes fell by close to 40%. During the early weeks of the COVID crash in 2020, they dropped more than 30% in a matter of days. Imagine logging into your super or brokerage account and watching years of savings evaporate almost overnight. That kind of volatility can be genuinely hard to stomach. Shares also don't typically produce meaningful monthly income for most everyday investors. Index funds do pay dividends, but the yield tends to be modest. A $150,000 portfolio might generate somewhere around $250 to $300 a month. Useful, but nowhere near enough to replace a full-time wage. And then there's leverage, which cuts the other way too. Noah used $50,000 to buy $50,000 worth of shares. Jack used the same $50,000 to control a $250,000 asset. When property prices rise, that leverage magnifies the gain, but it works in reverse just as easily. If prices had fallen instead of risen, that same leverage would have magnified Jack's losses.
It's a tool that cuts both ways, and the share market simply doesn't offer an equivalent. So which investment actually wins? Honestly, that's the wrong question. Jack believed property was the proven path to wealth. Noah believed the share market would quietly do the heavy lifting. Both of them were only partly right. The real winner was never determined by the asset class alone. It was determined by understanding everything that came bundled in with it. The money, the time, the stress, the risk, and the opportunity cost. The truth is, there's no single perfect investment. There's only the one that suits your goals, your temperament, and the life you actually want to live. So next time someone tells you property always beats shares or shares always beat property, ask them one simple question. Did you include everything? Because the answer that accounts for everything is the only answer that actually matters. If you found this breakdown useful, drop a comment below on which strategy you'd choose, and don't forget to subscribe for more deep dives on building wealth the smart way.